From the year 2000 to the year 2010, the S&P 500, the index everyone tells you is safe, returned -9%. If you retired in 2000, your portfolio was cut in half by 2002. Then it recovered. Then it was cut in half again in 2008. If you didn't have a plan for the storm destroyed you. Imagine it's February 2036. You are 10 years older, maybe have gray hair. You have worked hard, you have sacrificed vacations, and you have faithfully put $1,000 every single month into the stock market because the gurus told you it always goes up. You open your brokerage account, expecting to see a fortune. You expect to see the magic of compound interest. But instead, you see a number that is barely higher than what you put in. 10 years of your life. Gone. Right now, in 2026, with the market at all-time highs and AI hype exploding, we are staring down the barrel of another potential lost decade. Today, we stop gambling. We are building the fortress portfolio for long-term. We are using 4-5 unbreakable pillars to ensure that when the market crashes, you get paid, and when it booms, you get rich. Stay in this video because pillar number 3 is the new turning point that can serve as an edge to preserve your wealth.
Before we lay the first stone, you need the operating system. Wealth isn't about being a genius once. It's about being consistent forever. The protocol is ABB. Always be buying. Most people try to time the market. They wait for a dip, they wait for the election, they wait for the Fed. While they are waiting, the market moves without them. The fortress is built on automation. Whether the market is up 20% or down 30%, the system stays the same. Every 1st and 15th of the month, money moves. Why? Because when the market crashes, and it will crash, you shouldn't be scared. You should be drooling. A crash is a blue light special on wealth. It's a 20% off sale on your future freedom. If you can commit to ABB, let's build pillar number 1.
Pillar number 1 is the bedrock. This is where 40% to 50% of your money lives. This is the money you cannot afford to gamble with. We are talking about broad US market ETFs. If you buy one stock, you are betting on a CEO. If you buy a broad market ETF, you are betting on capitalism. If you owned Sears stock, you went to zero. But if you owned the total market, you simply deleted Sears and added Amazon. Here are your 3 tactical options for the bedrock. Option 1, VTI, Vanguard Total Stock Market. This is the king of diversification. It owns every single public company in the US. You own the giants like Apple and Nvidia, but you also own the small biotech firm in Boston trying to cure cancer. You own the regional bank in Texas. You own the steel mill in Pennsylvania. The expense ratio is 0.03%. That means for every $10,000 you invest, Vanguard charges you just $3 a year. It is basically free. Option 2, VOO, Vanguard S&P 500. This is for the investor who says, I don't want the small guys, I only want the winners. VOO tracks the S&P 500. It holds the 500 largest, strongest, most profitable companies in America. Historically, VOO has slightly outperformed VTI because the big tech giants have grown so fast. The expense ratio is the same, 0.03%. If you want the same ETF that tracks the S&P 500 but costs less in terms of share cost and expense ratio, then SPYM is your sure bet. I spoke about it in one of my videos. Option 3, VT, Vanguard Total World Stock. This is for the true doomsday prepper. What if the US stops being the world superpower? VT owns the entire planet. US, Europe, Asia, emerging markets, over 9,000 stocks. It costs a little more, 0.07% expense ratio, but it guarantees you will own the winner, no matter which country it comes from. My verdict? If you are in the United States, pick either a VTI or VOO, as it helps with tax. But if you are away from the United States, VT could be your best option. Either ways, just pick one of them.
Now that we have a foundation, we need utilities. We need electricity. We need flow. Pillar number 2 is the cash flow. Most investors only make money when they sell. That is called capital gains, and it's a dangerous game. What if you need money to retire in 2030, but the market is down 30%? You are forced to sell your shares at a loss. You are eating your own seed corn. The Fortress doesn't have that problem. We use dividend ETFs to create an internal cash flow. Here are my 3 options for good dividend ETFs. Option 1, SCHD, Schwab US Dividend Equity. This is the fan favorite, and for good reason. SCHD is a bouncer at the club. It doesn't let just any company in. To get into SCHD, a company must have a 10-year history of paying dividends, strong cash flows, and no excessive debt. It yields around 3–4%, and the expense ratio is a tiny 0.06%. In a lost decade where stock prices stay flat, SCHD is still paying you rent every 3 months. Option 2, VIG, Vanguard Dividend Appreciation. This is for the investor who wants growth more than income. VIG focuses on companies that have raised their dividend for 10 years straight. These are the aristocrats: Microsoft, Visa, United Health. The yield is lower, around 1.8%, but the price appreciation is usually higher than SCHD. Expense ratio, 0.04%. Option 3, DGRO, iShares Core Dividend Growth. This is the Goldilocks option. It has a broader basket of over 400 stocks than SCHD, which has about 100. It focuses on sustainable growth. It costs 0.08%, which is still very cheap. My verdict? Allocate 20% of your Fortress here. Reinvest the dividends while you are working. Live off them when you retire.
Pillar number 3 is the shield. I'm going to be real with you. Gold is a pet rock. It doesn't produce anything, it doesn't innovate, it just sits there. So why do billionaires hold it? Because gold is fire insurance. Governments print money. It's what they do. In the last 4 years alone, we printed trillions. When the supply of dollars goes up, the value of your savings goes down. That is inflation. Gold is the only asset that cannot be printed. It is the fear gauge. When the world is scared, gold goes up. In 2008, stocks crashed 37%. Gold went up. Here are my 3 top options for the gold ETF. Option 1, GLD, SPDR Gold Shares. This is the big one. It's massive, liquid, and easy to trade. However, it has a high expense ratio of 0.40%. That's expensive for an ETF. Let's see the next gold ETF. Option 2, IAU, iShares Gold Trust. This is the smart alternative. It does the exact same thing as GLD, but it only costs 0.25%. If you are holding for 20 years, that difference adds up to thousands of dollars. Yet, there is a cheaper gold ETF. Option 3, SGOL, Aberdeen Physical Gold. This is my personal favorite for safety. I own this myself in my portfolio and benefit from its recent growth. The gold is physically allocated in vaults in Switzerland and London. And the best part? It has the lowest fee, 0.17%. My verdict, 5 to 10% allocation. You hope you never need it, but when the financial hurricane hits, you'll be the only one smiling.
Pillar number 4 is the escape hatch. I love the USA. You love the USA. But home country bias is the silent killer of portfolios. For the last 15 years, the US has been the only game in town. But trees do not grow to the sky. Remember 1989? Japan was the king of the world. Remember the early 2000s? Emerging markets crushed the S&P 500. History moves in cycles, and right now, the US market is expensive. If the dollar weakens, or if the US economy stumbles for a decade, you need a tower in another land. Here are the options. Option 1, VXUS, Vanguard Total International Stock. This is the everything but America weapon. It holds over 8,500 companies outside the US. Think about it. You buy VTI for Apple and Microsoft, but who makes the chips inside the iPhone? TSMC in Taiwan. Who makes the car in your driveway? Toyota in Japan. Who makes the food in your pantry? Nestle in Switzerland. VXUS owns all of them.
Right now, the US stock market trades at a price-to-earnings ratio of around 25. International markets are trading closer to 14. That is nearly a 40% discount. By buying VXUS, you are buying $1 of earnings for 60 cents. It's the biggest on-sale sign in the global economy. Expense ratio, 0.07%. Option 2, VEA, Vanguard Developed Markets. Maybe you are scared of geopolitical risk. You don't want your money in China, you don't trust the government in Brazil. I get it. VEA is the safe haven international play. It only buys developed first world economies. We are talking about the UK, Japan, Canada, France, and Germany. These are stable democracies with strict laws. You get the diversification of foreign currency and foreign industry, like German engineering or French luxury, without the risk of a government seizing your assets overnight. Plus, developed international stocks often pay higher dividend yields than US tech stocks. Expense ratio, 0.05%. Option 3, VWO, Vanguard Emerging Markets. This is for the aggressive investor who wants rocket fuel. The US population is getting older. Europe is getting older. But look at India, look at Southeast Asia. These populations are young. Young people buy houses, they buy cars, they start businesses. That demographic wave drives massive economic growth. VWO invests in these hungry, high-growth nations. Yes, it is volatile. It will crash harder than the US. But if a country like India becomes the next superpower in the 2030s, VWO is the ETF that captures that explosion. Expense ratio, 0.08%. My verdict? Keep this allocation at 10 to 15% of your fortress. It's your insurance policy. If the US keeps winning, you're fine. But if the global cycle flips, and it always does, this is the pillar that saves your decade.
We have the foundation, the cash flow, the escape, the shield. The fortress is safe. Now we want to get rich. Pillar number 5 is the rocket. We are betting on the Silicon Age. My best 3 options. Option 1, SMH, Vanak Semiconductor. This is the pure play. This is for the investor who wants to grab the bull by the horns. SMH is aggressive. It holds the biggest, most dominant chip makers in the world, and it is not afraid to concentrate your money. Its biggest holding? NVIDIA, the king of AI. But it also holds TSMC, Taiwan Semiconductor. If AI takes over the world, SMH goes to the moon. But, and this is a massive warning, SMH is violent. It is not uncommon for this ETF to drop 40% or 50% in a single year. You have to have a stomach of steel to hold this. If you panic sell SMH, you will lose your shirt. Expense ratio, 0.35%. Option 2, SOXX, iShares Semiconductor. This is the heavyweight rival to SMH. It is very similar, but with a critical tactical difference. While SMH loves the international giants like TSMC, SOXX focuses heavily on US-listed companies. You are getting massive exposure to Broadcom, AMD, and Texas Instruments. By choosing SOXX, you are betting on the American chip ecosystem. It's slightly more diversified across the different types of chips, not just AI, but industrial, automotive, and memory. It's the same supercycle thesis, but with a slightly different flavor of risk. Expense ratio, 0.35%. Option 3, QQQM, Invesco Nasdaq 100. Maybe you think chips are a bubble. Maybe you think NVIDIA is too expensive. That is a fair argument. So we use the smarter play. QQQM tracks the top 100 non-financial companies on the Nasdaq. You still get the chips. NVIDIA and Broadcom are in here. But you also get the tech utilities. You get Apple, you get Microsoft, you get Amazon and Google. If the AI chip bubble bursts, Amazon is still going to ship packages, Google is still going to sell ads, Microsoft is still going to run every office in America. QQQM gives you that explosive tech growth, but it wraps it in a layer of safety because you own the monopolies that use the chips, not just the ones that make them. And the best part? It is the cheapest option on this list. Expense ratio, 0.15%. My verdict. This is the penthouse. This is the 10% of your portfolio that can change your zip code. But treat it like dynamite. Do not put your rent money here. If this sector crashes, your fortress, VTI, CHD, gold, survives. You will be fine.
But if this sector moons, if AI really is the next industrial revolution, this 10% slice could grow so large it allows you to retire 5, maybe 10 years early. Take the risk, but take it responsibly.
So, let's go over these Fortress portfolio for the long term again, shall we? 1. Foundation, 50%, VTI or VOO, the bedrock of America, or VT if you are not in the US. 2. Cash flow, 20%, SCHD, VIG or DGRO, the cash flow engine. 3. Shield, 10%, SGOL or IAU or GLD, the inflation fighter. 4. Escape, 10%, VXUS or VWO, the global insurance. 5. Rocket, 10%, SMH, SOXX or QQQM, the bet on the future. Most people watching this video are missing pillar 3 and 4. They are 100% in US stocks and 0% in protection. They are one recession away from a lost decade. Don't be the guy staring at a flat line in 2036. Build the fortress, automate the buying, and go live your life. I want to know which of these 5